Good afternoon. I'm Ron Dvergsten, and this afternoon I'll be presenting a segment for our 2020 analysis, farm financial management information, and concentrating on the 2020 Northland College financial summary, or as we refer to it as our whole farm summary report. This would be one of a series of 6 different segments related to the 2020 farm financial management information. What I wanted to cover is the financial summary that comes from 312 farms that work with one of 8 instructors at Northland Community and Technical College. Want to concentrate, once again, the report is broke out into, first of all, the average of all of the 312 farms, but then we also divide it up into different segments based on 20 percentile groupings. So we have our low return group here by net farm income with 62 farms represented in that set of data. And then on the other side, we have 63 farms that are in the high 20% based on net farm income in the 2020 farm year. So once again, just going to concentrate on the key financial highlights. And we always start out with net farm income is one of the key financial measures. And as you can see in this income statement section, how that's all derived at. So one of the key things here is we take a look at gross farm income on average over a little over $903,000 was the average gross cash farm sales for the year. We take a look again, the low return farms were at 437,000. The high profit group were over 2.1 million in gross farm cash income for 2020. Once again, the cash expenses on average 736. The low profit farms at 393, and the high profit group were at 1.7 million or close to it. So again, when we take a look at net cash income, and this is after we would adjust for some depreciation, this is what the farm would be filing their 2020 taxes on. So the average at 166,000, 43,000 for the low group, and 416,000 for the high profit group. The big sector I do want to look at, and this is where we make our accrual adjustments that from when you take a look strictly at your income tax return, is a section for inventory change. So on average, we had an increase in inventory from the start of 2020 to the end of the year on average of $57,000 plus. That comes in the form of could be an increase in total value of crop and or livestock animals held for sale, additional prepaid farm expenses, or a combination of all of those, or if it's on the other side, maybe a decrease in account payables that you might have had after the tough financial year of 2019. So again, when we take a look at this is where the difference really comes in on between the high and low group is in this change in inventory. So our low profitability group, even though they had positive cash income, their inventories went down by just under $30,000. Add in the depreciation of 20-some thousand, actually leaves them then in a negative farm profit level, where when we take a look at, the high profit group, we have a positive inventory change here of over $214,000. Subtract off our depreciation charge of almost 135,000, leaving net farm income from operations at 495. And then we have some other adjustments here for some gain or loss in capital sales. So we end up with our $508,000 of average farm income, with a median income of 451. So again, when we take a look at our average is where we'll primarily concentrate, but I did want to point out that significant difference between all farms that we deal with, and the fact that these larger farms do tend to bring up the average. So when we compare our median grouping here, or this would be the halfway point, where we would have, in essence, 156 farms that would be less than this, and 156 farms that would be higher than the median income of 106,596. So once again, on average, quite a good year, but I do want to point out we had our segment of about 20% of the farms that did have a non-profitable year. When we take a look at our other profitability measures, the rate of return on assets, rate of return on equity, when we look at them on an average, rate of return on assets at 6.3, rate of return on equity at 8.1. We do like to see our rate of return on equity higher than the rate of return on assets. And when that is the case, we are showing that our borrowed money is working effectively for us. So again, when we take a look at the low return group with negative net farm income, their ratios stay negative, and the loss on the rate of return on equity is actually larger than their return on assets. So once again, in that case, illustrating their borrowed money, or probably an excess of borrowed money, is creating some of the issues with that. Take a look at our high profit group again. Ratio is very good. Rate of return on assets at 8.4. And this past year, like I say, when we take a look at if people have money in the bank on a CD, you're lucky if you can get 1%. A lot of times we're looking at established farms. If you can average in that 4 to 5%, you're doing actually quite well. So this group really did have quite a good year. As we move on and take a look at some other sectors of our financial standards, we'll move into our liquidity and repayment. I'd like to take a look at our working capital position and changed working capital, and also our working capital to gross income ratio. So again, like I say, it's one of those where we end up here with our working capital at end of the year was at $318,000. Working change in working capital actually was an improvement of $106,000 from where we ended the 2019 year. So a nice improvement there on average. Once again, when we take a look at our high profit farms, they ended the year with over $1 million in working capital and increased their working capital during the year by over $336,000. and bringing their working capital growth income level to a very strong 45.88%. Compare that to the average of 35.8 or 34.8. A guideline that we like to see is that working capital gross income we consider very strong at 30% and above. So again, we see our low group and even the median group here in less than, or not too bad a position, but a little room for some improvement. Again, with the low group, we did see some improvement in working capital. So even with that said, with a lack of profitability, they were able to improve their working capital position modestly, and actually their working capital to gross income being on a positive side is actually pretty admirable when you look at all of the numbers. Term debt coverage ratio, another key one that lenders in particular take a hard look at. So once again, on average, the group did quite well with a 2.23 ratio. Our low profitability group again struggled at 0.35, meaning that they would have needed to either use working capital built up from prior years or need to do some restructuring on payments that were required to get made during the 2020 year. Our other groups, again, still doing pretty well with the median at 1.86. Usually, again, if we're in that 1.5 term debt coverage or better, consider yourself doing actually pretty well from a cash flow standpoint. And again, the high group at a 3.12, very good financial measures in that sector. Okay, as we move on to our solvency measures, and we'll take a look at that from a market standpoint, which most of our lenders like to. We take a look in farm business management. I do want to mention that we do balance sheets both with a cost side balance sheet, which we're putting assets at the price that they were bought, such as for land or beet stock. The cost value is what the farm paid for those assets. Machinery, we take the purchase price and a roughly 10% annual depletion charge for those. The value of crop inventory and that type of thing would remain the same on both the cost side and market. Market value, again, you see with total assets, we're at 2.6 million plus. And when we take a look at the market side, we're at 3.4 million. So again, that $700,000 on average is the balance sheet equity that the farmer has really gained from, in most cases, it's usually value of land that during the years that they've owned it has increased in value based on our current market values compared to what they paid for it when they did purchase it or possibly inherited it, etc. So just wanted to put that out. And again, you see the difference here between the high and low farms, the high return farms at just about 5.9 million in total assets on the cost side, and over 7.2 million on the market base. So once again, larger farm, larger asset based on our high profitability farms, which typically does get to be the case. They're the more established operations, have probably a higher percent of land owned and paid for. Those type of things all come into play. Same as we take a look at our overall net worth and net worth change. Net worth on average at $1,966,000. The low group at $952,000, and the high return group at almost $4.4 million. Here again is one of the key things, as far as looking at bottom line for the year. How did your net worth change? So again, from looking at the cash income, we had $170,000 plus in net farm income. We ended up being able to improve our net worth change by just about $150,000 on average. Our low 20% group were kind of a push, or showing just a slight decline in net worth of only $130 loss. The median group at $96,000 positive, and our high return group improving net worth by about $355,000 for the year. Once again, our debt to asset and farm debt to asset ratio, 40% on average, leaving 55% of the ownership to the business. So it's surprising how not a huge lot of change, even from the low farms to the high return farms. Only an 8% difference in the balance sheet. But again, you do see a correlation that it's a steady trend up with a higher debt percent as profitability goes down. Okay, and then we'll take a look at the total crop acres. So again, in 2020, for our 312 farms involved here, 1,547 acres was the average. The low profit group farms average about 757 acres. The large profit farms were over 3,500. So it does stand to reason that, when you have virtually 5 times as many acres on average, that profitability should be stronger with those operations. The blend of owned and rented land, owned acres on average represent about 25% of acres farmed, with the 75% of the acres being cash or share crop. Another financial measure that I do like farm management farms to take a look at and pay attention to is where their machinery investment or machinery value per crop acre is. This past year, we ended up on average at $451 per acre. The high profit group was a little bit higher, probably had more of the Red River Valley farms included in here, tied to acreage size and so forth. So again, if you are raising the higher return crops, such as or more acres of corn, soy, or corn, sugar beets, potatoes, edible beans, that type of thing, typically there's specialized equipment needed to raise those crops, and we'll tend to move those up. If you're pretty much a straight soybean and spring wheat grower, you might end up closer into this $300 and some category, but it is a good one to look at. And one of the other recordings in here talks about other reports we can run called Rankum that really brings information out and shows your individual farm numbers. One other thing I wanted to point out here, this is a new report that just came out with FinPak this year, is the statement of owner's equity that we can generate here from our database. So I just wanted to go through and point out one of these key concepts that we like to look at in showing the value of FinPak is to not only reconcile cash and make sure all of that balances, but also that we're balancing our net worth and we're not distorting numbers due to increasing values or so forth. But anyway, just wanted to go through here and just illustrate in general how that change in net worth is going to occur. So in this case, out of our 312 farms in this database, beginning net farm or net worth was 1.8 million. And again, we talked about the difference between the high to low. So we've got our starting net worth. Then we bring in, excuse me, our net farm income, our cash income for the year of $170,000. Then we also had $38,000 here of personal or non-farm income that adds to that. Then we subtract off the $66,000 on average spent for living or owner draws. Took off almost $12,000 for income tax. And then we had a modest change in personal assets. So on average, if somebody increased checkbook balances or improved the value of their vehicle lines, that type of thing. So when we make all of those adjustments, we come up to get a calculation called the changed in retained earnings. So this is out of our 170,000 after we've paid taxes and living, accounted up for off-farm income, we've got 132,000 to the positive. Then we have some other adjustments here. Take a look at if for inheritance were given or brought in, capital contributions that may occur from different entities such as a LLC or LLP corporations, that type of thing may have some of that going into. But again, once again, a pretty modest change of less than $1,200. Change in value of capital assets, so increase of $42,000 plus, and that came about most likely from increase in land value or possibly some increase in market value of sugar beet stock, equity growth from co-op patronage equities, that type of thing, all kind of contribute to that. And then we have our other thing that comes into play on the market side. We do have deferred liabilities, which actually declined. So that's reduced from the 42,000. So again, that change in deferred liability on average is actually an increase to deferred liability. Once again, you see with the large farms that increased by over $100,000, and a lot of that ties back to that increase in inventory. So usually when we have the larger our crop inventory base gets, at some point when that does go to sale, we have pretty much expensed the expenses that went to produce it. So we usually set a figure of about 30 to 35% of that at some time during the life of the farm may end up going to the government to cover potential or future tax liabilities for the business. So when that comes into play, net worth for the year turns out at roughly $150,000. And as we took a look at or talked before, virtually a break even for the low group and $355,000 for the high profit group. So again, virtually 150 added to our 1.8 comes out to our $1,966,000 net worth balance for the year. So when we take a look at that, only a modest discrepancy amongst 312 farms averaged $330 some of net worth changes that we were not able to account for. So overall, everything reconciled out very closely. So once again, just to wrap up, this is another new document that has came into play here, is our FinPak Scorecard, which again really does cover the key financial standard measures, which we've already went through, but just wanted to point out the key financial measures. Now we have 20 plus the financial measures. Back in the 90s, we started out with 16. I usually like to look at about 8 of them as key factors. The 2 that I like under liquidity is working capital and working capital to gross income. Both of these, when we look at it on average, we're doing very well. Solvency measure for a group, debt to asset at 45% that we talked about, leaving net worth or equity to asset at 55%. So overall, a pretty decent position to be in. Profitability measures, we talked about those. Again, on average, doing quite well. Again, with the low 20% having some issues. Term debt coverage, as we talked about, just in a final review at over 2.2. Once again, very strong position. And under the efficiency measures, the 2 key ones I like to look at here are operating expense, and kind of the bottom line gets to be your net farm income ratio. These 4 measures will always add up to 100%. So again, if we add all of those up, we might be off by a 10th for rounding or something, but in theory, they should always add up to 100%. The rule of thumb that I have really came to is that we do want to see this operating expense ratio stay below 80%. Again, we can look at that for, with this data set really shows that impact. Our low profit group here, we're almost at 90%, and we see what happens then with their net after taking a depreciation and interest cost. They're at -3. So again, as we talked earlier, they had minus $13,000 average loss from the farm for the year. So once again, it's really key that the lower this ratio stays, generally, the more we have left over here. And as we can see with our high profit groups, they were at about 68%, leaving them over 20% in net farm income. And that 20% on up, that really takes a good year to to get to that level. So once again, on an average across the board at 18.7, a very good year. Same with the operating expense. So again, I did want to point out, please watch your operating expense ratio and the trend that your farm is on. And it does really make a difference as we go into some higher prices. Really do help keep this ratio down. That it does tie back to a percent of gross revenue that generates that. So many times our cash expenses stay similar from year to year. We just want to keep the percent low enough so that we have plenty to meet our own personal family needs and to continue to grow the business. So that ends this segment on farm financial ratios for the 2020 Northland database group. Thank you.